Hello Property and Propenomix people, and hello Propenomix people, and welcome to another live supplement. So, if you've watched before, you will know I like to start with a quote, and this week's is, "London isn't as sought after as it was a decade ago." And that was from Damien Shepherd, who works for Bloomberg News. And this quote pertains to the deep dive, as usual this week. I'm taking a look at the rumoured demise of prime central London and how it's performed over what is now starting to be called the lost decade, as far as PCL is concerned. But as the calendar creeps towards a new year, it's a natural time to pause and tackle the biggest challenges that keep small to medium-sized enterprises, property businesses, from achieving true sustainable growth. For most, this boils down to two core areas: laying a bulletproof strategic plan for the next 12 months, and finally cracking the code on financial measurement and accountability. If you've ever felt lost in a sea of bookkeeping data, or if your productivity methods are falling short, it's time to switch from doing to leading and truly understand how your assets are performing. Book in on our next property business workshop with myself and Rob Turner. It's Thursday the 22nd of January. It's in central London, and the link is in the show notes, or it's at tinyurl.com/PBWNINE. So I'll crack on with Trumpwatch, which is where we start these days. The Donald is in full flow, it seems, as we sit and realise we've not yet completed 10 months of his 48. Will his 48 be all that he's got left in him? Because there's been a lot of chatter in the last few days as well about whether he will have a third term. Now, obviously, the minor issue that it's completely unconstitutional to do that is in the way of that at the moment. But is he serious? Is he not? We have to bear in mind he is 79, and I think he loves winding people up as well. So bear that in mind as well. There are various mechanisms that could see him do it, some of which seem more legal than others. But we'll find out, won't we, when 2028 rolls around. Time seems to go so quickly these days, but in the context of Donald not being 10 months in, some might argue it goes pretty slowly. The government shutdown is continuing. The press focus for the last week has been on the fact that alongside that, half of the White House was demolished unilaterally whilst federal workers are visiting food banks to survive whilst they're not being paid during the government shutdown. There are a ton of estimates about the financial costs of the shutdown, but the estimate is about $15 billion of output per week being lost. They get thrown around. Ridiculous amount of money, not a ridiculous amount of money in the context of the US government, but about equivalent to a week's worth of tariffs. Strangely enough as well. So output lost is about equivalent to tariffs gained, interestingly enough. Now, the stock market's largely ignored this, right? Its S&P 500 hit another high in the absence of meaningful government data. There could be a shock, or there could be a gap up. There could be a big move either way when data is available after everything's been sorted and signed, but no indication of that happening just yet. But the PMIs continue whilst the shutdown is on because they're not government data, they're produced by a private company, and they buoyed the stock market forward. PMIs for services at 55.2, which is a print we dream of in the UK. The manufacturing PMI also printed 52.2 for October. Now inflation printed 3, but to put that into context, expectations were 3.1, so ultimately, even though it was the first time it started with a 3 since January 2024, it was still deemed to be a pretty good result. The big dog is embarking on what looks like a book signing tour of Japan and South Korea to firm up or officially launch $900 billion worth of investment from said nations in what was effectively part of a plea deal for the tariff negotiations. So you can't argue that some of those tactics are having some effect in terms of it being a levered tool for his trade negotiations. It does look pretty smart, to be honest with you. If you haven't seen his AI-generated response to the No Kings protests, you just can't do anything but admire how much he really doesn't care about what anyone else thinks of him. And I have no doubt that's been a major part of the success he's been achieved in life. Don't get me wrong. The 250 million he got from his dad for his property businesses didn't hurt, of course. But whether you hate him or not, or you like him or not, you've got to consider his response. And the thickness of his skin is something incredible. Now, it won't be that easy to actually get this 900 billion and get it all deployed in the way that he wants, but he doesn't concern himself with those little details, so why should we? It always feels like a relief to get back to the real-time UK property market. Chris Watkin has had a week off with the video content this week, but as usually still providing some interesting snippets that are worth a chat. His primary thrust this week was providing some context, which I love when we're talking about data. His main points, well, we're nowhere near a 2008 style market, but also we're nowhere near a 2020, 2021 market either. This market is very balanced, and the output that we look at from Mr. Watkin week in, week out would very much support that. Are there doom mongers and clickbaiters out there? Absolutely, but there always are, right? Many who call for a crash. I reflected on some YouTube comments. My YouTube's been going for a couple of years now, and there's one person particularly who's followed me around for those 2 years telling me the crash is around the corner. I'm not sure how big that corner is, but it's clearly more than 2 years wide at this time. But those people aren't really recognising how much inflation has brought the market back down to earth without there being a huge amount of blood on the carpet. It's a bit like a balloon it didn't pop, the balloon, when the whole Liz Truss scenario happened. It's just the air has come out slowly, a slow puncture, or by controlling the side of the balloon, or whatever you want, the opening of the balloon, however you want to use that analogy. Is it tricky in London at the moment? Hell yeah, this is what Chris focuses on. But then it's been like that for a few years in the data. The same goes the more prime you go. We know from recent weeks that houses over 500k are struggling to sell, and the headlines from leaks from the Treasury haven't helped. The most recent leaks are around a 1% rise in income tax, I know, this week. The one thing that really just needs to happen, to be honest with you. Prime London is another level altogether. Just ask yourselves one question. If you could wait, which the vast majority of people who are going to consider assets in prime central London can do quite comfortably, why on earth wouldn't you? I always give Chris a weekly shout out here because he's more prolific than only his epic stuff that he releases on a weekly basis about the UK property market. He has great stats available many days a week. Drop him a like, a subscribe, a comment, some kind words for his content creation. And if you're in the industry and you want some help in positioning yourself as a local market expert, being more in touch with your local market, and you want some help in being a better communicator, that's Chris's core business. So give him a shout. His articles are on the Property Industry Eye website, and the video is on his YouTube channel, which is @ChristopherWatkin. Okay, on to this week's macro mania. What's in there? Inflation? Well, it's big, but it's not that big. The Rightmove asking price report alongside the ONS from private rent and house prices as well, and then the Flash PMIs, and then last up the gilts and the swaps, of course. So a nice surprise for inflation, the nicest for a long time. I don't remember the last time the print was 0.2% below the consensus forecast. A big miss to the downside, and it's a big one as well, the biggest print of the year. The September inflation number defines the increase in universal credit, job seekers allowance, employment support allowance, income support, housing benefit main allowances, statutory maternity, paternity, sick pay, child benefit, pension credit, DLA, PIP, and more combined. Now remember, the main pension is already protected by the triple lock, so that gets CPI as a minimum. Alongside definitions, it also significantly influences the national living wage increases. Back to earth though, the CPI print was still 3.8%. The target, is still 2%. The expectation was 4% from the economists, however. CPIH, which the ONS for years has preferred as their more reflective measure of inflation, printed 4.1. That includes housing costs, which is more like the US version of CPI. However, printing short is always good news for the economy when inflation is above target. There was quite a shift in approach and attitude to interest rate cuts. The intermediate effect was that a cut in November went back to odds on, according to the markets briefly. The market moves and ebbs and flows, but the probability of a rate cut this year led to 75%, up from 40%, which appears to be more likely, according to the market, in December than it is in November. November is too soon, although if it did play out like this, November hold, December cut, it would be the first time there is a no new news rate cut in this cycle. So that the new news is the MPC full report. There'll be a new full report for November. Now, it isn't quite as straightforward as all of that, is it, though, apart from anything else? So what else have we got to consider? Well, there are two other things, right? The first one's the date of the budget, November 26th. And it makes sense for a cautious bank to see what happens first and how Rachel gets out of the corner she's boxed herself into. The second is the positivity it creates going into a new year. And let's face it, we really need some positivity from somewhere. Personally, I don't think it will be a consensus vote, but I am currently a hawk because I'm a traditionalist and I've been an inflation bear for nearly 5 years now, and I've been proven right about the persistence of it and the return of it in this cycle thanks to the 2024 budget. There's still a 40% chance of November being a cut though. I'd expect a close vote, but I'd have 50p on the vote being 6-3 in favour of holding the rate. I might change that before the meeting though. Back to deeper detail on the inflation report then. Core CPIH 3.9%, down from 4 last month. Core CPI 3.5, down from 3.6, and down from an expected 3.7. So everything was a bit lower than expected, but still far too high. Trends are important. I say this all the time, one swallow does not a summer make, but we've moved in the right direction in this report. What about the conspiracy theory side of things though? Did the government fix the number to get a lower CPI print? Well, it does save about £2 billion on the index-linked benefits and the index-linked gilt payments that undershoot the print at 3.8 rather than 4, that is. So it's not nothing, but in the context of £2.7 trillion worth of debt, it isn't worth losing credibility for, in my opinion. And also, none of those people who might be able to fix it have got any skin in the game. It's no one's money, but it's everyone's money, if that makes sense. So regulars will know I love to look at OOH as well, the owner-occupier measure of housing inflation. So it's synthetically created, but it's the best metric we have in the housing market. It climbed from 5.3 for August to 5.2 for September. So this is the closest that CPI, CPIH and OOH have been since early 2024. OOH actually makes up 17% of CPIH, and it's basically what's added to CPI to make CPIH. So that's the relationship between the three metrics, right? In more specific detail, food inflation calmed down massively from 5.1 to 4.5, obviously still too high. Transport went up significantly. Education inflation remains above 7% due to VAT on private school fees and other changes to charitable structures. Breaking back CPIH, it represents a 2.9% increase in goods, which is the highest since October 2023, and a 4.9% increase in services. Very, very close to how much wages are still inflating, please note. CPI services were up 4.7 as we truly struggle to shake this anchor around 5% that we have found, pretty much where wage increases have been, which again is no fluke. The ONS highlighted the fact that the OOH figure made the smallest contribution to CPIH that it had made since January 2024. So what? Well, we've seen this part of the cycle where housing costs are forming a disproportionate part of CPIH upwards. I was waiting for some months, in fact it felt like years, for the peak in OOH, which was 8% in January 2025. So 5.2 by September feels like significant progress. Inflation remains well above the other comparables in the EU and also comfortably hotter than the US. However, historically that's often been the case. There is a different reason this time, individual policy on employers' national insurance, but it isn't so far out as to be ridiculous. The EU is over target at 2.6, with Germany at 2.4. Enough. House prices. Starting with the ONS report. Remember, when they talk about rents and house prices in the same report, rents talk about the month before, so September, whereas the house price part is only for August. Rents still up 5.5% year on year because, as always, they continue to lag the moves in inflation that have occurred over the last 4.5 years. That's down from 5.7 for August, and it's continuing to trend downwards, but it's still 9.1 year on year in the northeast and as low as 3.8 in Yorkshire and the Humber. The ONS has house prices up 3% to August 2025, but remember they lag the other major indices by about 5 months. So the recent drops in this figure since about June, this is Chris Watkins' pound per square foot sold, have not really been reflected yet in the ONS numbers, although they haven't really been reflected in the nationwide or Halifax indices yet either. What we could be seeing, of course, is that ever cheaper places are transacting well and the higher value stuff is sticking. So we know this is the case, but if that's happening more than ever before, the price movements suggested by the Watkins sale price per square foot figure are not reflective of prices falling. Instead, they're reflective of more cheaper stock selling in even higher ratios than normal because of this budget pause in the higher value market, primarily because of this speculation over the summer of, I couldn't turn the radio on over the last few days without hearing the words mansion tax, for example, and it's got people rather paranoid, especially in parts of the country where anything over 500 grand, say, most certainly does not buy you a mansion. You wouldn't even get a 3-bed semi for 500 grand. So it's all relative, right? So the July figure, 3.2% for capital growth. So a little haircut there, but not a lot compared to the month before. So what did we see? We saw 3% in August 2025. So small amount downwards, right? Average prices according to the ONS. Well, England 296k, Wales 211, Scotland 194, Northern Ireland 185. So Northern Ireland prices are still moving forward more quickly than the others. They're up 5.5% annually. And as that long trend has continued, and as Mr. Watkin referred to this week, the North continues to lead the regional tables, followed by the Midlands, followed by the South. London is bottom with a 0.3% drop in prices year on year now, according to the ONS. Is that seasonal effect to a point? I mean, it was plus 1.3% year on year of last month. And there has been some speculation that last summer was where things started to move, because aside from anything else, it was where the first rate cut was. However, that wouldn't really have impacted on transactions that completed in August 2024. So maybe not too much logic in that, but it is a big adjustment to go from plus 1.3 to minus 0.3 in just 1 month. It's a big shift. But the Northeast is winning, depending on which side of the fence you're on, plus 6.6% year on year, and it was plus 6.9% in July. So the regional rent table looks the same, similar, but not the same. I mean, Yorkshire are at the bottom, so that's obviously a northern region, but the other southern regions bring up the rear below the average, but alongside the West Midlands as well. The North are still winning in the rent rise table. So yields are actually still increasing overall, and if you look at that throughout, you can see that in the report. You know, rents up in the Northeast 9.1, capital growth 6.6, so both up significantly, but rents up more. And overall, if you look at it, you know, still in the low fives for rent rises, but in the sort of 3% region for capital growth. So yields still expanding as we talk in resi at the moment. How long will that go on for? Not too much longer, I don't think, but we're going to need to wait until there's a decent capital growth bump, rather than just something that's bumping along at or below inflation. Okay, what about Rightmove and their asking prices? Well, their October report released on the 20th. They saw asking prices up 0.3, which they characterised as smaller than usual for October. They're also down 0.1% year on year. So up 0.3 on the month, down 0.1 on the year. So haven't moved Rightmove asking prices in 12 months. Sales agreed are also up 5% according to Rightmove's data. The 10-year average October bounce is 1.1%, so 0.3 really is modest. Why? The decade high level of stock, which checks out, and it's in line with the analysis over here over the past recent months. September 25 was not as strong as September 24, but mostly because there was the first rate cut in a while, which was taken into account in September 2024's asking price market, and there was early action being taken to avoid the stamp duty discount period, as it's now been badged, that came to an end at the end of March 2025. So, Rightmove new buyer and new seller inquiries are both down 5% year on year, which gave me a bit more confidence this trend of more and more listings has perhaps reached its peak in this cycle. However, new buyer demand is up 2% on the year versus 5% more listings thus far. Sales agreed year to date up 5% too. Now, I feel the need to qualify here though, that's Rightmove listings, but actually across all the portals, as we know from following Mr. Watkin week on week, listings are only up a couple of percent year on year, but Rightmove listings are up 5%, so there we go. The three Rightmove patented categories are closer in annual performance than they've been at any point this year. First time buyer asking prices, 0% movement. Second steppers plus 0.2, top of the ladder plus 0.1. So that surprises me, but it's only one snapshot and I do expect that to change. First time buyer asking prices will drastically outperform top of the ladder, I think, in the future months. Now, how we can get increases between 0 and 0.2 when the overall increase in asking prices is 0.3 month on month, don't ask me because the maths of that escapes me, but you'd have to ask Rightmove. But I think the commentary in seriousness was very sensible from Colleen Babcock, who's their resident property expert. Not enough pent-up momentum. Well, I'd say there's none really, because stamp duty changes cleared out all the pent-up momentum. It might be a little after the budget if there's lots of waiting and seeing going on, which makes loads of sense. And also if the budget is okay for everyone, which I'm sure it will be. You know, the doom mongering that goes on before these things is ridiculous, but people can't help but be influenced by it, because it's how the 24-hour news cycle makes its bucks these days and gets its eyeballs and its clicks and all the rest of it. Let's see what happens. I'd be fairly sanguine about the whole thing. It's not stopping me buying any houses at the moment, I'll tell you that. I think it'll be similar to last year. In fact, unless you ran a small business last year where you obviously took it pretty tough. Not enough positive sentiment, again, back to the budget there, but overall both consumer and business confidence indices are suppressed at the moment. There's no two ways about it, even though they've been improving a little bit lately. And of course, a lot of choice in terms of stock on the market. Well, I agree with all of that as it goes. And a healthy dose of budget trepidation was added in by Colleen. That wasn't just my budget trepidation there. Rightmove didn't say it, but I did wonder if the mooted changes for the buying and selling process do come in. Basically, the Scottish Home Report system. You can mess around calling it something else if you want, but that's what it's going to end up being, because it's always the way with these things. Will that affect sales volume before it comes in? Because buyers will want to wait to perceive that they're getting a better deal. Will we see a glut of listings before the extra cost of several £100s in listing a property on the open market is introduced? So lots of sellers and no buyers in a period over a couple of months? Well, no, because information distribution isn't perfect. But there will be an element of impact, you would think. Rightmove do, however, approve of the fact that housing is well within the Overton window at the moment. Personally, I think that's proof, if you want to, and you show strategic leadership in an area, even if some of it is clearly misguided or at least badly informed, you can get a less popular policy area into the spotlight. Okay, anyway, the PMIs. Those who know that I love a good PMI, real-time information direct from the private sector. They're not everything, but absolutely the engine of growth in a healthy economy. Good news overall, even though the prints are a little bit limp. On the upside, when the prints have been improving in recent months, before the Q3 down-to-earth prints that we had, they tended to then be revised upwards again when the final numbers come out in the early days of the following month. So I'm hoping we can see the same pattern again here. The composite print was 51.1, and so was the services flash print. Manufacturing 49.6, so not back to the magic 50 handle yet, but a massive improvement on last month's 46.2 and the 12-month high. Services have hardly moved there, but the composite print is up a full point. So this was a better report than I feared we might be in for, with budget paralysis being mentioned. Logically, I hope businesses would take the fact that all of the tax being talked about is personal tax, basically, although LLPs have been drawn in over the past week or so, and that won't help. But it's all too recent to be included in these PMI numbers. And therefore, I think businesses would be less worried than they were before the 2024 budget, which turned out to be completely justifiable, let's face it. But let's hope that holds up for November's report, but I'm still a bit bearish around that one, I'm afraid. The ultimate conclusion I've come to, ignoring a lot of the noise and the ad hominem attacks, is that Rachel Reeves is yet to gain the trust of the private sector, if she ever will. What did Chris Williamson, the chief business economist at S&P, have to say? He hopes the September print was a cycle low, and this gives us hope that it might be, although there's time to come yet. Output has picked up in manufacturing, services demand is up, especially from consumers. He's probably more positive than I am. A slight uptick in business confidence and moderation in job losses, inflationary pressures coming back into line with levels consistent with the Bank of England 2% target, according to Chris. I mean, this is pertaining solely to the input costs for businesses, I should say, not the wider economy, because core inflation at 3.5% puts 2% inflation comparatively out of reach for the next 12 months, in my view. But it is better than the 3.7% print that was expected for core CPI, as I said earlier. And Chris does acknowledge this is consistent only with GDP growth of 0.1% monthly at most. He also points out the JLR restart was helpful, as that was large enough to have had an impact at a national level due to original equipment manufacturers and indeed all the wider members of the supply chain when it comes to JLR. Exports are still falling and tariffs are still getting blamed there as well. He's talking more about budget outcomes now, whereas I'm still concerned over budget trepidation for November. But perhaps I'm being property biased there, whereas Chris will be much more business focused, of course. Okay, any guilty pleasures to consider this week? The open, 3.985% yield on the 5-year, and the close was 3.906. And the week was completely defined by Wednesday's inflation figures. We had that drop below consensus. The yields took a bit of a kick in, but then since then they drifted back upwards slightly. So only losing 8 basis points on the yield over the week when such a considerably significant event happens is not really reflective of how much of a big miss that was. So the current underlying pattern seems to be drifting upwards rather than downwards. But these prevailing winds only last until the next move of significance, which can potentially be in the UK, the US, or even somewhere else in the world. But then again, if it was easy predicting bond yields, everyone would do it. Thursday's close was 3.886% on the 5-year, and the swap yield that ran alongside that was 3.569, 32 basis points below the gilt, preserving that discount we've seen emerge over the past 12 to 18 months. Lower than both 1 month ago and 1 year ago, where both of those figures were closer to the 3.75 mark, which is much more reflective of the average 5-year swap yield over the past 18 months or so. But all these moves are in the right direction, so let's not look a gift horse in the mouth. How about the 30-year? 5.34% yield opened the week, but only 5.218 at the close. So a haircut of 12 basis points, and therefore a 4 basis point advantage on the 5-year. The yield curve got a little shallower, but things still look very tempting for long-term, truly passive investors. Okay, it's time to get heavy. Last week saw such a glut of industry-relevant reports that this week missed out a little. Some will breathe a sigh of relief when they hear that, I'm sure. The 2 items that couldn't go without reporting on, though, were a report from Savills around residential development land and also Hamptons' autumn market insight. So Savills produced this quarterly report centred around land values, what's been thrown around in the industry, given construction costs are up an official 17% in the past 3 years. And that was after a gap adjustment upwards during the pandemic itself, remember, whereas prices are up a tiny percentage by comparison, especially on new build stock. And the suggestion that's often used in these reports is that this is because of this redistribution of costs for developers. So if you imagine, remember the old adage of a third, a third, a third, a third in the land, a third in the build, and a third for profit. No one really works to those margins anymore in development. I'm sure they would attest to you. It obviously put a lot more on the cost of developing the land, which squeezes down either or both of the developer's margin and the price of land in the first place. So there's very much been a margin squeeze for house builders. Bellway were working to about 17% margin when their figures were released. But then, these companies were working to 30% plus profit margins back in the good old days of the 2010s, once they got the shackles of the great financial crisis out of the way. But this report leads with land market holds firm. And that seems to be my overall sense of the land market in normal, less turbulent times. Never goes down in price, right? Well, check this out. There's much less likely to have been leverage used to purchase undeveloped land. There's not a lot of people that will lend on it, certainly not high loans to value. And then the owner is much more likely to be a larger asset holder. These are my general senses of landowners. Not really backed up by my usual dose of facts and figures, but if you go onto the land reg round by you, go onto some mapping software if you use some, and have a look at who owns what around and about, you'll probably find that stacks up pretty well. So Savills' official figure is 0.3% growth in land values over the past year. So much like residential property, although a little bit lower, inflation is still doing most of the legwork in price adjustments that have been happening, mostly since 2022. Land prices aren't discussed as widely, and real inflation-adjusted land prices are discussed even less. You can be sure that real land values have dropped more like 25%, if nominal land values are down 10% since the middle of 2022, which they are. So Savs also have a balanced style figure. This is like the RICS residential house price balance. And the balance is plus 22% for positive agent sentiment, but that compares to plus 47% last quarter. They talk of the pressure that urban land is under at this time. And in a week where it looked like Steve Reed actually has been reading the supplement, well, I'm joking, of course, but it does seem like he's listening to the industry. There's been an announcement that fast track planning, plus some sill relief and the likes, is being offered in London at 20% affordable rather than 35%. A lot easier for Steve Reed to do that than Rayner, of course, but I think he's using this opportunity to right some of the mistakes she'd made in this area. It's been great to see fairly quick action being taken, and the government's responded to the true evidence of genuine collapse in house building in London. The Moneywell report specifically has been cited as the one that cut through. I analysed it the previous week. Ultimately, it wasn't speculation, it was just reportage of the facts. But greenfield land is much more resilient, according to Savills: steady demand, constrained supply, the classic economic case for holding land prices up. And back to my overall characterisation in general for the market for land. Scotland and the north of England are seeing heightened engagement, in a phrase that's so corporate it oozes. Urban land values are down 3.2% year on year, and planning consents in the year to June 2025 were down 34% compared to the 2021 peak. The stats are in the report, but they're so bad they're only very lightly referred to. They then revert to mini article format for the rest of the report. First up, London. The analysis is all about policy and the brakes that it's put on the London market. Central London land values are down 7.2% year on year, and outer London is down 12.3%. Significant haircuts. Whilst this is a Resi report in a desperate search for positivity, they refer to the flat office land market in outer London and the fact that central London office land is up 2% on the year. So where is the robust demand for land as house building overall suffers from the 18-metre rules and viability challenges? Purpose-built student. The word that is constantly wheeled out in this area is robust, and the projections out to 2030 look good for student numbers. It's no mistake in my view that development where space standards are far more liberal than in single residential stacks up far better than the broader marketplace. There isn't that level of understanding of trade-off, it seems, or the regs overall have gone too far and it's been too long before having a sensible conversation about this. Again, props to Steve Reed for jumping on the affordable requirement in London very quickly, but if he ignores the fact that of the 280,000 plus unbuilt permissions in London, which were referred to in the Moneywell report, 90% of those are over 18 metres. Then you're not going to see the urban property problem being solved without addressing that Building Safety Act and the Fire Safety Act. So in the greenfield market, Savills segment things by region, and as usual, this is illuminating, and it won't surprise you at all when you compare it to how that breakdown works in terms of capital values in the secondary market, which is actually what I specialise in week to week, as you know. The UK annual growth of 0.3 in land breaks back to 2.3 in Scotland and 1.1 in the West. Where land values are concerned, the East printed minus 0.9 and the Southeast minus 0.6. So same story as with the cap growth to an extent. Then they close this report with who is doing what, and it's the major house builders with particular appetite for sites from 100 to 250 homes who are replenishing their land banks. Public companies, PLCs, are active. The SMEs are struggling more. Savills point to the fact they struggle with deploying incentive schemes in the same way PLCs can. SMEs only use them on 12% of sales versus 24% in the PLC sector. SMEs have therefore got a limited appetite for new sites and are focusing on delivering their existing commitments. Section 106 appetites are also low from housing associations, although healthy in Wales where transfer values are fixed. Savills' implication there being that the system works. Land-led schemes of 39 billion commitment are favourably mentioned as helping to stimulate demand for these schemes. The final chapter is on what planning changes will start to filter through into increased applications. Second half of 2026 is the current estimate, which sounds reasonable, but like everyone, Savills puts emphasis on the next cuts in the base rate, which makes more sense for debt financing specifically because it takes place at the shorter term end of the yield curve. Whereas I question the relevance of it for 5-year debt and house prices overall, as that 5-year swap rate has been very stable, as I've been saying for some time, for about 18 months, in the face of 5 base rate cuts in the interim. So hopefully that's interesting stuff. Hamptons quarterly market insight then. What's their take? Cautious but steady. The same story we keep hearing and what we would expect. They speak of a modest uptick in activity, but an element of underlying fragility. A very fair characterisation of what I see in the heart of the nation, it seems, at this time. They refer to the more hawkish tone in the recent Bank of England report, although the week's news around lower inflation print is the most dovish sign for some time, realistically, in my view. They weren't to know that because that was after they released this report, of course. Anisha Beveridge, who is their head of research, makes the point I've also made over recent weeks. Swap rates had nudged upwards, so the expectation was higher product rates when existing product allocations ran out. Happily, the news this week has taken those swap rates back to where they were in early August, under 3.6%. London prices are now plus 8% in the past 5 years against an inflation backdrop of 28%. Remember, that's CPI, not RPI, which was higher. So on one side, that improves affordability, of course. On the other side, it provides a very limited incentive for discretionary sellers, which is a good point well made by Anisha. There's then a look towards the budget, and Hamptons concentrate on 3 of the 50,000 seeming property tax or structural changes that have been mooted: shifting stamp from buyer to seller, annual property taxes on top of council tax rather than SDLT, and then moving the capital gains exemption on private homes. They point out the first 2 require a massive systemic overhaul, which is exactly why they won't happen, of course, whereas the third could be done more quickly, although they do stop short of saying what political suicide that would be. But then the report shifts its focus to this lost decade, which actually is a sort of phrase that's been more associated with Japan and its economy that struggled from 1990 onwards. But this lost decade is in prime central London. Landreg data shows a 5% price rise in the past 10 years. So if you consider inflation over that time period being more like 40%, that is one massive real terms adjustment. But don't forget the meteoric rise behind those properties from the early 90s onwards. Some data suggests that PCL values have fallen over the past 10 years. So the PCL premium is therefore down from 55% to 31%. And that's the premium between truly prime and a posh suburb of London, like a Fulham or something like that. So the average gross gain since purchase, however, since people have on average owned these homes for over 10 years, is £599,000. Not to be sniffed at. But the first time this has been under 600,000 since 2012. 24% of those who sold a prime home this year lost money. So that's only gross. That's just looking at purchase price and sale price, not including all the frictional costs they would have incurred along the way. So it'll be much more than 24% when you add those in. A year ago, that was only 7% of people. Now, Hamptons have this graph in the report. They stratify it by year of purchase, and it breaks back to 60% of sellers this past year, who bought in 2015-16, lost money below their purchase price when they sold in the past 12 months. So this 10-year mark that's basically approaching is analysed as Hamptons by potentially kicking off a self-perpetuating cycle of stagnant transactions, because the 10-year ownership level is a key one before moving or selling up. Most sellers here are not particularly motivated. They don't necessarily have huge mortgages. There's a lot of cash ownership, so they can happily just sit there or unhappily sit there, but they'd rather sit there than take a loss to an extent until they get far enough down the road of that journey of wanting to be a vendor. There's an argument put forward by Hamptons that reform to SDLT could restore liquidity to the PCL market, but I just can't see Labour embracing taking down the tax burden on prime price property. If you don't have to find 12 to 17% on top of the transaction in the first place, and you pay something every year, however, even if that was fairly equivalent to the 12 to 17%, which is bound to be, might be interesting if it was ever to happen, but I'm not holding my breath on that front. This is not a radical government. This is one of tweakers, as I've said before. So next up is an analysis of what 4 mooted policy changes would do to London and the South's market. CGT changes moves to a 0.48% annual property tax. Both of those 2 rated as having a very, very high level of impact because these are the most expensive property markets in the country, and the argument is more expensive, more impact. They then discuss what if we shift SDLT incidence from the buyer to the seller, and they say that would actually impact the upper to mid market the most, and also the mooted increase or levy of national insurance on landlords in their personal name. So that the largest impact on that bit of the market will be on personal name landlords who are under 65. That's what they say, presumably because national insurance drops off at retirement age. But you can see the inherent problems in this system, and this is exactly why what I've been saying is scrap employee national insurance and put it on income tax, because That's what needs to happen. Forget picking on landlords. It's just absolutely ridiculous to do that, and it will hurt the supply side of the market even more, and it will stop people wanting to get into being a landlord, and it will start to shrink the private rental sector if that hasn't already happened. I personally believe that it is already happening. Most of the real-time data that we've got pretty much clarifies that and shows us that. Hamptons then move on to their lettings index, but as you can tell, the whole thing is biased towards London and the South East. So according to them, rent is down 0.4 on the year to August 2025, drastically different to the ONS data loss sample that was discussed earlier on in this article that ONS reports on. And also, as I always say, when you're talking about somewhere like Hamptons, an agency, ultimately, they're talking about new rents. They're not talking about existing rents. So there's a huge distinction between those two as well. Demand is down 4%, supply is up 8%, as Hamptons sees it. They make a couple of distinctions as well. Airfares are up 81% in 5 years. Water bills are up 61%. Rent is up a fair chunk less than a lot of other household costs, which is a longer term trend. It's just that everything has gone up quite so much that it's more often difficult for people to make this sort of distinction. And of course, the average tenant spends a lot more on rent than they do on airfares or water bills, for example. So the absolute rise still makes a big difference, not just the percentage rise. They also point to rising rents as being one of the reasons the bank hasn't been able to hit its 2% inflation target. I'm not so sure of the validity of this argument, though, particularly because the inflation target is based on CPI and not CPIH, as the ONS would prefer, as I say every month when we look at the inflation report from a technical perspective. So housing costs are not comprehensively included in CPI. Nevertheless, they make a good argument. Rents could have gone up more or less. Plenty has gone up more that is effectively day-to-day expenditure, but rents have outpaced inflation, although not on Hamptons index in the past year, of course. Hamptons always measures some interesting stats which don't seem to feature anywhere else, or specifically don't feature in the ONS. They have good day-to-day relatability. For example, the average discount for a renewed tenancy is £90 a month on an average rent of £1,387. So it's about a 6.5% discount for already being in a tenancy. The record in the recent cycle was £170 per month in October 2023, so the gap is narrowing. Before the pandemic, that discount was between £10 and £20, which is why rent rises on existing rents will continue to outstrip inflation for some time yet, in my opinion. How about the number of people leaving London? Well, that's slowing down. Hamptons don't mention changes to second home rules, which I also think would have had an impact, but the return to the office continues, and the subdued growth in prices of both rents and purchases are having an impact, which of course they will. In the first 7 months of 2025, there were 31,620 homes bought outside the capital by people who are moving from inside the capital. That's about 5.3% of deals. It was 5.9% before the pandemic, and it was 63,600 in the first 7 months of 2021. Hamptons describe a shift in focus from aspiration to affordability, with Dartford being the most popular destination, measured by the percentage of transactions there that take place from people moving outside of London, from inside out, basically. Greater London is now at 23% in the past decade, compared to 55% elsewhere in the country. Now, this is vindication for what I was saying on social media back in 2015, because the top in the London market was very, very clear, data-backed, but instead at the time I was absolutely pilloried by people telling me I had no idea what I was talking about. Okay, that'll do for the I told you so's for this week. But how does this sort of shift actually play out? People moving out of the capital can afford on average 533 square foot smaller properties than they could in 2015. So they can still get a larger property, but it's 533 square foot smaller than it was 10 years ago. So they basically lost 2 large double bedrooms. I mean, that's the size of a generous 1-bed flat, isn't it? Which is the analogy that I'd use. The other factor is a regional shift. We knew that in 2021 there was a huge preference for the Cotswolds, Cornwall and Devon. That's changed to staying nearer to London, congruent with the return to the office. It all still sounds like a pretty good deal. And the average move gets 121% more space. But in 2016, that number was over 200%. There's been a heavy focus there on London specifically, which isn't a particularly relevant market to me in many ways, because since I really started to scale, which was only 2015 or so, London has been completely off the table for me in terms of both yield and my expectations of capital growth. However, over recent years, I've come to appreciate much more how the fate of London and the surroundings shapes policy quite so considerably around the country. So the overall feeling is if there's a bright future there, if the current administration can do what they've promised and actually cut the regulation that will make a difference. The FT, incidentally, ran an article this past week about how housing was the area where regulatory cuts had made the most difference. So I can absolutely despair about the other cuts that have been made in regulation, but there we go. So, as I draw this week to a close, the next property business workshop is prepared, and as we turn our eyes to 2026, the next workshop is online and tickets are available. We start the year with a bang, discussing strategic planning and how to get the most out of the next 12 months, with some of our own methods and takes on productivity and time management, alongside systems and processes. The other half of the workshop is about the most common pain point in SME property businesses: accounts, bookkeeping, and group accounting. This is about measuring asset performance. It's not how to use Xero, but how to make the most out of financial information. What should you be seeing monthly, and how should you interpret it properly and use it strategically to grow your business safely but quickly? As always, we have real-life case studies about our own experiences and close with our no-holds-barred Q&A. Anything individual to consider? Get yourselves a VIP ticket. Join us for dinner in a smaller setting with an opportunity to discuss any specific roadblocks or issues in your property business at the moment. Join us Thursday, 22nd of January 2026, Central London. It's tinyurl.com/PBWNINE, or there's a link in the show notes. But above all, please remember to keep calm, always listen to the supplement and carry on. There will be opportunities abound this year and towards 2030 and beyond. The landscape has been set for a surefire bull run. It will be slowish and take a little while further while things get off the ground, and the amount of stock around is keeping things a little bit suppressed at the moment. But as the market continues to improve slowly, it's a case of here we go, in my opinion. Thank you.